Mr. CIO Quan.
Mr. Speaker, sir, I'll make 3 observations and raise 3 suggestions on the proposed Single Bill. First, my 3 observations, which all relate to a larger point about long-term planning. Indeed, fundamentally, Single reflects this government's commitment and orientation to plan for the long term and govern in the long-term interest of Singapore. And so my first observation is about this government's long-term plan for our national infrastructure. There are very bold, ambitious plans for Changi Airport Terminal 5 and a 3rd runway, for a mega seaport in Tuas, for a massive expansion in our MRT rail network, and much more. All in turn to anchor Singapore's next phase of development well into SG 100. At the same time, Singa has an eye on the government's 100-year plan for our coastal defense infrastructure to secure Singapore against the very long-term threat of rising sea levels posed by climate change. These long-term infrastructural plans are essential to our mission of continuing to improve the lives of Singaporeans, present and future. And indeed, our history clearly shows how we are the current beneficiaries of long-term plans and big bets in strategic infrastructure that previous governments had made. For example, plans for the first container terminal in Singapore and the region, located at Tanjong Pagar, were made way back in the 1960s, when containerization was not yet the norm. In fact, far from it. The government then had to borrow $45 million from the World Bank, a very handsome sum back then, and the container terminal was completed in 1972. The first vessel the terminal received had 300 containers on board, compared to the more than 1,000 people gathered on shore to receive it. So 300 containers, 1,000 people receiving that. And in fact, container volumes did not really take off until the next decade in the 1980s. But finally, the long-term bet paid off, and since then, more long-term plans had been made and implemented for the Brani terminal in the 1990s, Pasir Panjang Phase 1 and 2 in the 2000s, and Phase 3 and 4 in the last decade, such that we have the Port of Singapore that we have today, after almost 60 years since the first plan for a container port was laid. In short, it was a decisive bet, a far-sighted decision, and a constant focus on what's next and what's on the horizon that had allowed Singapore to move ahead and stay ahead of the competition. It was a similar story with Changi Airport. Plans were made in the 1970s with the aim then already to be Asia's largest airport at the time of opening. A significant amount of land had to be reclaimed, and Terminal 1 opened in 1981. Plans were made in the 1970s. Terminal 1 opened in 1981. Terminal 2 then opened in the next decade in 1991, followed by Terminal 3 in the decade after that, in 2008, and of course, Terminal 4 in the following decade, in 2016. So decade after decade, a quantum leap each time, anchored on robust long-term planning and execution. Looking ahead, therefore, Singa, I think, underlies this government's continued commitment to a long-term, ambitious strategy for our national infrastructure to secure our future and success well into SG 100. My second observation about long-term planning is about this government's commitment to a long-term fiscal strategy. to sustain and properly steward our strategic fiscal resources and to take full advantage of our strong fiscal standing in the best long-term interest of Singapore. Crucially, the government is not looking to borrow for significant infrastructure because it lacks money. Quite the contrary, it is looking to borrow so as to take full advantage of our fiscal strength and the expected low cost of debt capital going forward. Instead of expending our existing financial resources for lumpy infrastructural outlays, when these resources could be deployed and invested to generate good returns for Singapore and Singaporeans. In other words, the government's strategy of borrowing for infrastructure on the one hand and investing on the other is an astute long-term strategy to fully leverage relatively low interest rates and avoid the opportunity cost of dipping into our own resources. The third observation I would make is this. Beyond Singa and beyond physical infrastructure, I think successive governments have always made long-term plans and investments in our soft infrastructure, in human capital development, to ultimately improve the lives of Singaporeans. And it will continue to be a constant work in progress. But let's look at the track record. Through the decades, successful governments had invested steadily and decisively in education, in skilling Singaporeans, because ultimately that is our surest way to better opportunities and better lives. From 6.5 billion in the 2003 budget to 13 billion in recent years, from a focus on 15, 16 years of formal schooling to now learning for life, I think it is clear to see how much successive governments had invested in education for Singaporeans. Successive governments had also invested steadily in Singaporeans' health, from 2 billion in 2003 to 6 billion in 2013 to 12 billion in 2019. And of course, this government has said that it would do even more going forward. Successive governments had invested billions in defense, which is in turn absolutely vital to create the basic conditions for Singapore to thrive. They have invested significantly in research and the building up of our base economic capabilities, and they have invested significantly in our social capital to strengthen our social safety nets. And so we need to look beyond Singa, beyond physical infrastructure, about successive governments, including this government's approach to long-term planning and development in general, which has always been about the whole of society, the whole of nation. So I have three suggestions on the proposed provisions of Singa. My first suggestion is to lower the cap on total borrowings. The proposed cap of 90 billion in the bill represents roughly 18% of GDP. This is quite significant, especially if a profligate government were to take over. And on this, I echo Member Murali's Pilay's point about us not knowing what would happen in the future. 90 billion is not quite enough to run the country to the ground, but certainly enough to cause a rather bad bout of indigestion. And so to maintain public confidence, I suggest that the initial cap be lowered to 50 billion, which would represent roughly 10% of GDP. This lower cap would nonetheless give the minister sufficient space to operate within the Act initially, and the government can always come back to Parliament when there is a need for the borrowing cap to be raised beyond that. My second suggestion is to lower the cap for total interest payments. The proposed cap of 5 billion in interest payments alone represents almost a quarter of our entire development outlay per year in recent years. And so to signal prudence, I suggest that the initial cap be limited to 2.5 billion, or roughly 10% of recent annual development outlays. Given our credit rating and trends in long-term interest rates, I think this lower cap should be quite practicable. My third and final suggestion is to reconsider the qualifying limit of 4 billion for a nationally significant infrastructure project. I'd like to ask the Ministry how narrow a range of projects it expects to qualify under the Act, given the proposed limit of 4 billion. And would major healthcare infrastructure projects, for example, which usually cost around 1 to 2 billion each, make the cut? If not, why not? If we agree that the value of healthcare infrastructure in terms of its social value is certainly of national significance. And so since we have the safeguards on total borrowings and total interest payments, I suggest we lower the qualifying limit for projects so that the scope of qualifying projects of national significance can be made more inclusive and more flexible. Mr. Speaker, sir, the above suggestions notwithstanding, I stand in support of the bill.